This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. As always, my name is Alex Perny, and today we are very pleased to welcome on Chris Gerardi with Realbricks, the COO and CTO founder of a new and interesting way of a take on crowdfunding. And again, I use the term for lack of a better one, but a lot of people are kind of familiar with the industry and in general, maybe what crowdfunding is, but it's something that is, relatively new. We're kind of taking our first stab at this industry coming through a maturation cycle, if you will. And with anything, whether you look at the Ford Model T and then going into what cars are today, no industry stays stagnant, right? Everything has an evolution cycle. Everything continues to improve and get better and get more refined. And we're really excited to dig into how Chris is kind of tackling that challenge with Realbricks and what things like crowdfunding and more specifically what fractional ownership can mean for you as the investor, and where some of the shortcomings of the industry may have been and where we're trying to create some efficiencies and improvements in that industry. So Chris, thank you very much for being on with us today. If you wouldn't mind, give us a little background about yourself and kind of how you came to be your current franchise with doing Realbricks.
Yeah, so my name's Chris Gerardi. I appreciate you having me on. Basically, what happened was 2015, I started finding interest in digital assets. I've always had interest in assets. I think I started trading on E-Trade my first year out of college, which is not as young as some people, but for me, it was pretty young. And what I realized is these processes are inherently cumbersome. When I first got into kind of researching and understanding digital assets, so like Bitcoin and stuff like that, it was still rather new. It was still cumbersome to transact in. And one of the bigger pieces that always came to my mind was I'm transacting in these markets and stuff, but what's tangibly backing these assets? And so I think just me as a person, I've always felt like, for inherent value that there should be some tangibly backed asset to it. And so that's really what started driving me into the space of a digital portfolio, but with real estate connected to it, right? And that's really where it started. And then in 2020 is basically when I really started building this out, and then did our first capital raise in 2021. And it's just been at it since then, basically.
Gotcha. Yeah, and that's really kind of a common core interest with a lot of our clients, and whether they're clients or investors, or again just in general whom we deal with on the professional side at Advanta IRA, it's the entire thing that we deal with our asset administration is tangible or non-traditional stuff. It's all well and good to invest in securities, but again, at the end of the day, it's a lot of really good faith in words that kind of gives these things value. You can't reach out, after I think like 1995, everything started being digitized with no paper certificates, like completely. So you really can't even reach out and touch your investments anymore, past just a mouse click or tapping on your phone. So, that tangible aspect is something that, I really enjoy over the past 13 years that I've been doing this kind of stuff. So, let's kind of, again, let's look at, again, what is kind of the problem that you aim to solve when you came in to the market? I think you said around 2020, because, excuse me, you're not the first person or company to kind of operate in the space. Again, crowdfunding as a general concept came out of the Jobs Act, which was the big piece of tax and financial legislation out of the Obama administration. And again, there's people out there doing that, but again, with any market and industry, there's life cycles. So what are some things that you thought, hey, I can do this better, or things that were maybe being underserviced or not utilized that kind of drove you to this?
Yeah, well, I think if we look at Jobs Act, which is still recently, it's still fairly new, right? Like fractionalization is still fairly new overall, and like you said, it's an evolution. I think when I took a step back, I took a look at it and I said, okay, like inherently, what are the benefits and what are the negatives about this? What are the wins and loses? And really, the win is it lets people get in with a lower barrier to entry. That's a win, right? Um, but even with that win, there was a lot of what I felt were cons, right? Which are, even if you buy in digitally, anybody who's in the space, they don't have, for the most part, a secondary market for you to get liquid at. You have no, there's time frames, there's all these things that basically you have to go through, these ropes and stuff to get your money out, your liquidity. And so when we think about like the fractionalized environment, I think that if you look at the current build out right now, it's still inherently archaic. Um, you can buy in and you can go through and purchase some asset into a fund, maybe what have you. But a lot of times you don't even really know what asset that is exactly, right? It could be a fund, and there could be multiple assets. Some of them might be winning, some of them might be losing, and so you can't visually see those assets a lot of the times, right? And so really the way that we took the approach was, hey, let's make this visual for consumers so they can adopt, right? One of the biggest thing is like adoption rate is still inherently low because there's just not enough understanding. So we said, let's make this visual, let's make this easy. Let's take what people have already seen. Let's make a platform that they've visually seen. So our platform mimics very close to like a Airbnb, a Zillow, a Redfin, when you look up assets on it. And then our app resembles that with swipe functionality, which kind of mimics like a Robinhood type approach, where you can swipe, right? And we said, hey, let's make it easy for people to enter the market. And let's work on building out that secondary market so we can make it easy for them to exit the market as well. And we felt like those were the three pieces that, as a consumer, we would want, which is accessibility, liquidity, and then the visual piece of it, right? Because people are visual people, right? If you think, a lot of people like to watch YouTube and stuff because it's visual. And if you look at Robinhood, the gamification of that application, I believe, is what was part of the winning piece of it. Yeah, sure, it was no fees, but the simplicity of it, right? You pick the asset, you swipe, it's done. It's like, so we looked at it and we said, hey, we don't need to reinvent the wheel. We need to make fractionalized assets simple to utilize. And that's really where our focal point came.
Okay, yeah. So again, kind of breaking that down to the accessibility, the visualization, and the entrance and exit to these. So again, to paint with a broad brush, again, generally speaking, crowdfunding would be, hey, if you'd like to own real estate, and they would give you maybe kind of a portfolio view of maybe what's held in a particular fund. But it's again not kind of so specific as to saying, hey, I own a part of a house. You own a part of a pool that owns a bunch of different houses, which again is kind of just a modern approach on looking at like a real estate trust or a REIT. It's you have a high level holding, and then you have the fund manager, and then you have the underlying assets that get bought and sold without much input from you, right? And again, to REITs, another thing that kind of translated into that was the illiquidity. Again, REITs being extremely illiquid, the fractionalized ownership again does, at least in the crowdfunding space, has a degree of liquidity, but it's certainly not something that you would consider a liquid asset, at least currently. So, kind of giving that primer to people when it comes to visualization. Now, again, looking at how crowdfunding is normally operated, so are you taking the approach of saying, hey, we're going to have more or less kind of again, that Redfin or the Zillow approach where you can go on and look at a particular property and then purchase into a fractional ownership of it, or kind of give an example or maybe a use case of how you're doing things that differentiates
Yeah.
it from the previous model?
So we have to break this up into pieces, right? That are digestible for consumers. Once again, fractionalized still to this day to the average consumer. They might understand what the word means, but it doesn't really like make sense to them from a financial standpoint and from an asset standpoint. So the way we looked at it is, hey, let's create this visual approach that shows each and every individual asset that they can buy into. They can choose, right? Maybe they want 123 Main Street, maybe they want 657, Wall Street, whatever, right? Like they can pick. And each one of those assets creates a different revenue profile and profit, right? So they can pick kind of based on that, and then if they want to sell those, they can sell those on to the secondary market. So there's that visual piece, but really for Realbricks, what we've done is, what we realized is, we created all this technology that allows this to be done legally and compliant. We don't have to manage every asset. If we really want to give customers what they want, why don't we look at this from a bigger view? And I think is the space is missing this as a whole. Because really what you have is you have a space where companies want to own and control the fund, right? Whether that's a Reg A or something else, right? A Reg D. They want to own and control the technology that allows for the transaction of anything to happen. And then they want to own the distribution. Well, that sounds good if you're talking about a market that's like, maybe $200 million, 500 million bucks. Say, great. Hey, you can corner that market. We're talking about multi-trillion dollar market. And so how do you really get this to scale for people? And so what we did is we said, hey, look, let's take the first approach, which is we'll create the tech, we'll make it compliant, we'll create a secondary market, we're going to make it the best tech in the industry, bar none. And then we're going to white label it. And we're going to let private equity firms, we're going to let builders, we're going to let issuers issue those assets through. So they can do all their regulatory stuff. They put it through our system. And then we can put that front center on either our app, the web app, and we're currently going through talks with getting it on other platforms. So I won't name it exactly once, but let's just say like platforms that you go look for real estate to buy on. Let's say that you're talking about platforms that allow people to buy into stocks. So now you're opening up the gates for mass adoption, because the biggest problem with the space is understanding, and because of that, there hasn't been mass adoption. Because once again, if it's going to be a trickle forever, you're never going to get to mass adoption. And so we look at it as a completely different scenario. Yes, we can run our own Regulation A and offer our own assets as a company, but really, why not let the asset issuers issue assets that they want to issue, and let the consumers that are on these platforms, millions and millions, to the tune of probably close to 100 million people on these platforms, let them decide what assets they want. I mean, really, at the end of the day, that's really what we want to deliver long term, right? It's kind of like the idea of Amazon. Start off as a bookstore, now they're a giant logistics company. For Realbricks, it's like we start off as we buy these assets, we issue them, we allow people to buy and transact in them, we prove that, we allow that on the secondary market, and now we open it up to the asset managers and the distributors.
Yeah, and that brings up kind of the next point that I wanted to look at, is that at least for me and a lot of people understanding at least more of the fund model, is that whereas, you plug money in and then the fund manager goes out and then, they might buy more properties. You get like a snapshot of their holdings, but, the buying and the trading is done through the fund model. Now, when it comes to kind of that individual, my question would be, is that how are these actually brought on and closed, right? Because, with fractionalization, you're not buying the whole thing. Let's say you put in $5, $10, $20,000, but the asset is, excuse me, 300. So are the assets that are being offered on here basically kind of pending a close? So like once it's fully funded, kind of like a closed-ended fund
Yeah,
closed?
so what we do is we currently purchase the asset.
Mhm.
Our shell company, it owns it outright. We don't purchase with any debt. We just buy it. We then open it up through regulation to allow everyday people to buy into it. And so what we do is we let it get funded, right? And then we move it to the secondary market. So if there's 40,000 shares, let's just take a $400,000 home, $10 a share, 40,000 shares. When those 40,000 shares are purchased, it's then moved to the secondary market, where people then can buy and sell. It's just ATS matching. But the unique piece about it is that when people do that, they're going to be able to see as close to lifetime value for that asset as possible, because we can get that data and we can mirror that data on the secondary. So maybe you paid $10 a share. Maybe that asset's gone up over the last year or 16 months, whatever it is that you want, right? And maybe it's gone up $1 or $2, $3 a share, depending on the value of that asset in the realest time that we can do on real estate. And then basically, if you want to sell that asset, then you have kind of a price point of what that asset is worth. So you not only get to collect on potential rental income, you now can collect on appreciation without waiting for the asset manager to sell the asset.
Sure.
And that's really like the key component here, right? Like, now I'm not saying that, this is going to blow up overnight and everybody's going to want this, but if we look at this 5 years down the road and we say, hey, what does fractionalized real estate market look like 5 years down the road? if people are going to want this because it gives them that ability to take profit at an earlier stage, and it gives them the freedom from the asset manager if they want it, right? And that, I believe, is inherently key. And I think that's a piece that everybody misses. See, because when you're an asset manager, the more assets you're managing, the more money you make, right? And so that they don't want to necessarily, they want to hold on to a lot of these, right? They don't want to give you your money back. But why not open up the market and let the market decide where that's going to be? I mean,
Yeah, and you bring Yeah, and you bring up some interesting points, especially when it comes to, again, management, because, again, moving from the traditional fund manager model, real estate's a lot of things, but kind of a set it and forget it is not necessarily. It's an asset that needs to be managed to a certain extent. So, things like repairs, putting tenants in, qualifying your tenants, dealing with termites and all the other kind of fun stuff that goes into owning real estate. So, where does the management of the asset component kind of fit in? Again, you have the fractionalized ownership of the individual asset, but these people, again, if they're just interacting through an app or a web platform, the idea is to be hands off, right? The the big sexy image of real estate is to be, have that passive income. People that don't want to deal with the minutia of the day to day management. So where does the kind of property management aspect of this come in? Is it something that is fleshed out by you as a company? You just have kind of a main provider, regional providers that provide this. So how is the property managed once it's actually put on the platform?
yeah, so it's, generally speaking, going to be regional managers that manage up the properties, right? They get a percentage. Um, but all in all, I mean, the idea here is that it's funny because people have this idea that like owning a bunch of rentals and stuff is such a glorious thing, and I'm not saying don't go do that if that's what you want to do. I'm just saying there's a lot of work with that, right? You just like you just said, you got to qualify the tenants, you got to find them. You have to collect rents. You have to make sure that they're paying their rents. All these different variables that come into it. And what people realize is once you start getting on beyond two, three, four, five, six rentals, it becomes a big job in consumption because you have to make sure all these things are handled, right? You don't want to let your asset get destroyed. So you need to manage that asset. Um, but yeah, regional, and I think as we open up the white label to issuing parties, they a lot of these companies, they have management arms that handle this stuff. I mean, I give you an example like a bigger builder, like there's some builders that make build to rent, right? They have 20, 30,000 homes that are all collecting rent. I mean, they have massive portfolios and they've been managing those properties for profit for years. So it's one of those things where it's like let the greats do what they're great at, because it's a large undertaking for the average person. And really what we're trying to look at is like, hey, the average person wants, I mean, what do you really want? You want to make some passive income, and you want time. Time is valuable. And so that's really what we model with our customers is, yes, flexibility and time, right? That and letting people dictate themselves what they want to do. I mean, I don't need to dictate everything for my customers.
No, absolutely. And that's really kind of one of the, again, kind of that golden goose that people are always looking to find in real estate. The attractiveness of the returns, the tax benefits, everything seems so great. But like you said, once you get past, I would say the market's even lower. I say once you really get past three rentals, it's a job. You're dealing with three different families. You're probably dealing with at least six different people. That's a lot to manage for someone if you have a 9 to 5. It's definitely kind of a lot to handle. And again, I've seen it play out time and time again, being in real estate for as long as I have. That the attractiveness of it weighed with the amount of work that goes into it is something that people don't realize, and it's kind of matriculated into our consciousness through social media and everything. It looks so nice and polished and sexy, but it's, again, where the rubber meets the road. There's the reason I call them real estate professionals. It's there's a professional aspect to this. So when it comes down to it, another big, again, attractiveness to real estate is taxes, right? Anyone that knows a lot about investing and things like that, almost all of them will have a component of real estate to their portfolio. And specific to that, there's a great amount of tax benefits to that. So, kind of two-part question here is that when it comes to what the individual actually owns, I'm assuming that if you look the public record in for any of these homes that get traded, it's not like a huge tenant in common with a million different people, and especially if it's being traded, it'd be a nightmare to do re-recordings. So I'm assuming it's something to where it's like each one of these are kind of like an individually formed like limited partnership or LLC that, allows for that kind of trading without, multiple recordings and things like that where people are buying into that. Can you get a little bit into the structure
Yeah.
of like I put
Yeah.
in $10,000, what is like at the end of the day, what am I getting,
So
in
you're so
relation to
you're
this?
so you're you are on a recorded cap table, right? So that's part of the complexity of build out for this, right? For this secondary market to work and fall in guidelines of SEC requirements and FINRA requirements, you need we had to create that ability to have digital transfer, right? So, say you purchased in Alex at 4 o'clock today, or we'll say 3 o'clock today, transactionally. You're pushed through. You're listed on that cap table, and what that cap table is ownership in that LLC that owns that property.
Mhm.
But
Okay.
you are a tangible owner in it. And
Yeah.
so that digital cap table updates daily. And so that keeps track of those legal pieces, right? Because let's just say, worst case scenario, they need to decide find out who the owners of this property are, so that way distribution happens, right? Just say anything can happen. Um, and they go through, they pull that up to date cap table, and it lists everybody's ownership. It lists
Mhm.
their ownership, who they are, and it's all recorded and captured. And so that's the tangibility of it, right? So yes, you're not, per se, like your name's all over the home, but you don't want your name all over the home anyway. It's like it just from a legality standpoint. So really what it is it's a way for people to have ownership that is tangible, that is connected, and is shown legally, which you can't get with, say, a digital currency necessarily, right?
Yeah.
Like, there's nothing at the end of the day. If things go to zero, there's nothing there for you to capture. At the end of the day, that property is still valid, and it will go. And if it was to ever go through a legal proceeding, that ownership is still there.
No, absolutely. And again, I asked that question mainly just kind of one for my own edification, but two to demystify it a little bit for people. And again, I would imagine, most of our clients and especially people listening to this podcast, are a little bit more savvy than most. It's not the people that you run into at your grocery store per se that are just getting their first stab at it. But, from your market, it certainly is. But again, it's important to understand that, especially in, real estate, just because your name isn't necessarily on a deed doesn't make doing things through like an LLC or a special purpose trust or a limited partnership any less valid in your underlying ownership of the asset. If that shell, the LLC is created specifically for that, well, if that's its only asset and you own the LLC, then again, there's, no appreciable real difference to that. You still own what owns that,
And
So,
if that house, if that, and the great thing about it is it's property specific, right? So no matter what, your cap table is attached to that particular property. So I mean, it's a thing where it's like we know who owns what property at what time, and if that property is ever liquidated, then that ownership is, shown, and then that owner is distributed according to ownership, and how much, who the owner is, and how much it is.
awesome. And then, the second big component of understanding this, it's never how much you make, it's how much you keep, right? And especially at the end of the year, people starting to hopefully take a little bit closer eye on, what your tax liability and your tax exposure is. And again, one of the beauties of real estate is how many write-offs that real estate can offer. So through this, what kind of pass-throughs are offered? Do you get to capture any depreciation? Is there any type of accelerated depreciation being offered through this? And that kind of leads into, the life cycle of these. How much are expenses passed through? Is it, on K1? Like, what are some of the pass-throughs that you as the investor get from this, or are some of them shielded and strictly just like, let's say, interest income or whatever it is? So how is the the income realized to the investor and what type of tax benefits pass through from this real estate holding?
Yeah, so that unfortunately right now, with the way things are built out with regulation and stuff, it's primarily going to be just like a taxable gain or loss like a stock, right? Most people are not going to own um number one, you can't own more than 9.8% of any particular asset that's fractionalized through Reg A.
Mhm.
So, um, most people are going to own, portfolios that are going to probably be somewhere around, 4 to 8 thousand bucks. They're looking for a long, they get to collect on the rents, stuff like that. If they decide to sell in the secondary market, they can, hopefully for a gain, if that's what they're trying to do. And they pay taxes just like you would pay on anything else. There's no great tax benefit as of yet. I do believe that's going to change, right? If we really think about like as this the what we have to remember is like fractionalized assets is probably similar in size to like if we go to Google 1999, 2000, I mean it's like small, right? It is. If you look at all the companies that are fractionalizing right now, there's not that many really that are doing it to where you can do everyday people. Some fractionalize, where it's accredited investors, right? Well, that doesn't pertain to a good amount of the people in society. So if we're looking at like how many people are actually utilizing this, I mean the whole entire fractionalized market is probably less than, I'm throwing a stab at this. I could be incorrect. I will be to some degree, but um, $12 billion, $10 billion. I mean, like it's so small, it's almost laughable because you're talking about just in real estate. What 30 trillion for? I mean, even if you just take residential properties and multifamily, I mean, you're in the trillions of dollars, right? So this is a market that has not been tapped, and it hasn't been tapped because bringing technology to merge with securities is inherently difficult, and then to scale it is difficult. And so that's why for us we look at it and go, we can let issuers put billions of dollars of assets in and pump them through the other side and just use our technology to make sure every transaction is compliant. That's really the key down the road. And I think as that grows and this becomes a larger market, then we will see a lot of change potentially, and those things will happen, right? Like right now, it's so small that there's not enough money in it for everyone to be like, hey, let's try to get some of these regulations changed, and so we can get some of these things that traditional models get, right? I think that will happen down the road. I think the biggest key is the players in the space have to think bigger and create opportunity that allows larger amount of money. If you think about Bitcoin, I'll just use that because today I think it hit 107,000 dollars maybe today.
Mhm.
When I first got introduced to Bitcoin, it was $234. I think the whole market might have been 3 or 400 million at the time. 10 years later, it's now 2 trillion. Might be a little bit past that. I'm not really sure, but you get what I'm saying, right? Like in 10 years, in 10 years, fractionalized real estate is going to look completely different. And that's going to be due to people and the players in the market making it bigger. And the more eyes and attention we bring to it, the more we can hopefully adjust regulation and adjust laws to make it have more benefit. And that's really the goal.
Yeah, and again, well, quick fun note when you were talking about Bitcoin, it's currently trading at around a $2.7 trillion market cap. So good for Bitcoin.
Okay, yeah, okay, which is crazy, which is
Yeah.
absolutely crazy to me.
Yeah, and it's like everyone, because I've been, I'm not the biggest tech nerd in the world, but I've built my own media server and a couple computers, and I stay up to date with it. And I remember looking at it back in, I want to say like 2015 is when I first got exposed to it, and it was probably, like $700, $800 back then, and I was like, oh, that's cute. And it's like, kick myself. But it's fun when you get introduced to new segments where you learn from that. It's like, hey, to be an early adopter certainly has risk, but if you can see where the trajectory is going, and especially if you've had other people kind of operating in the space and you can find a new way of doing things that's either better or more efficient, Jeff Bezos, not everyone wants to go to Barnes and Noble. It's nice to click on your computer on this new thing called the internet, have it delivered to your house, right? So again, the models that have been out there kind of helping to identify this stuff. And again, to your point about, taxes not being the kind of first and foremost thing to look at. Granted, your investments per property are going to be smaller. I think you said it's capped at 9% and change. You can't over the easy way. You can't own over 10% in this model structure. But once you get more people adopting it, and you can white label this out. Well, the big players in the space, they want to draw more eyes to it. They already lobby Washington. They're going to say, hey, we want to add more benefits to this. Let's get some tax incentives to people to do it. Let's be able to get more people invested in this kind of stuff, which helps them, helps their clients, help, your ecosystem. And eventually, again, that rising tide will ideally raise all the ships. But typically, at least if we look at historical models, whenever something new happens in real estate, typically the legislation will follow in a favorable direction towards real estate taxation or how people are investing in it. One of the few markets that's actually occurred in. You see people constantly looking at Wall Street and everything, and for the real estate investors in the room, you're like, yes, keep looking right there. Keep looking at Wall Street. Let us do the real estate thing and enjoy those tax benefits.
I think.
Now, go ahead. No, go ahead.
I'm just gonna say, I think for the first time to what you're talking about is if we can, if the players in the space today can think about things on a larger level, it might be one of the first times where we can really bridge a gap between Wall Street and Main Street, right? Wall Street has a huge amount of assets, and Main Street there's a huge amount of people who would like to have ability to own some of those assets. So through technology, we can kind of bridge that gap and allow Wall Street to let Main Street have at a lot of these assets and hopefully get reward from some of these assets. So it really brings together two worlds and lets both worlds, benefit. And I know that in people's minds, it's always been Wall Street or Main Street. They don't think about us or, well, we have to, whatever it is. Like at the end of the day, there is a way to merge some of those gaps and let both of them work together. I do believe that.
No, absolutely, and that's kind of an important thing also to understand is that when talking about just the two camps of Wall Street and Main Street, everyone understands real estate, whether you know it or not. You understand real estate more than you probably understand the stock market if you're painting with a broad brush over the entire population of the United States that is in a position to invest money. Like you live somewhere, right? Whether it's an apartment, someone owns it, it's an investment. Whether you rent a house, that's someone's investment. Whether you own your house, you've invested in your own home. The understanding of the value of real estate and its inherent benefits is something that, again, people don't realize how much they actually know about it. But being able to be exposed to it in a meaningful way is really kind of where that big disconnect happened. And to your point of being able to kind of democratize this last, kind of walled garden, everyone likes to look at real estate, but it's many things, but cheap it is not, right? Sitting in the average home price in the United States right now, it's gone down a little bit, but it's like what, like 140, 120, 145,000 right now. Like that's a lot of coin, right? That's kind of expensive just to go out and buy one. But being able to buy that fractional ownership again is something I think is really powerful in what can really change the market in a meaningful way for people to be exposed to this. And that's kind of where I want to transition to next is the liquidity of it. That's a big thing with real estate is that again with all these benefits that I can get on my soapbox and pontificate till the sun goes down. Granted, that's kind of early nowadays, but you have kind of a relatively illiquid asset class. You can't just sell it on an open market. You can't go down to your local gas station and pick up a Diet Coke with your real estate, right? It's not a inherently liquid asset, but that's something again that you really have with this platform aimed to change. So, kind of a bit of a recap and I'll turn it over to you. So you have these assets that are brought in, you've acquired them, you sell a cap table at a certain value up to a certain amount, and then you mentioned there's a transition to the secondary market. So let's talk about a little bit about how that transitions. Do you affix the value at the underlying purchase price, or do you revalue the property for the cap table, and then how exactly does it transition, and what are the functions of that transition to your secondary market?
So basically, for secondary market, it goes through some filing requirements through the SEC. It'll transition to what the cap table is, right? Because at the end of the day, that's what people put in. Now that might be a little different than the traditional marketplace at the current time, but the idea is that, hey, look, anytime you buy into something and you try to sell it right away, once again, not investment advice, okay? But your odds are not going to be favorable, right? I mean, let's just be clear about that. Like, discipline is inherently valuable anytime that you're going to invest in anything. And so if you're willing to hold on to that asset for a little bit of time before you decide to liquidate it on the secondary market, I think that obviously with tradition in real estate, it will surpass what that initial investment is. That is not a guarantee, but probably, I mean, if we look at past, so it gets adjusted to that, and basically, what we do is we pull information from the traditional market and pull it in to the secondary market. So basically, you can see, where the value is, right? It might change every couple of weeks, every 3 weeks. It really updates when the information's updating, whether that is a decrease or an increase. And so that's how someone can manage that secondary piece down the road. If they're like, hey, I've held this for 18 months and I want to liquidate it now, and it's a little higher than it was. And, that's the idea, right? And I think, once again, what we have to remember is this is still very, very new. This is not the run. This is not the norm. Like, this tech is new. How we built this is inherently new. And how this will be utilized in the future is new. But we have to also be willing to take a step back and look at other markets, right? It's like the internet. The internet, when it first started, was like, I don't know if you remember 56K dial-up, but
Oh yeah.
it was like, you're like, that's where we are today in so many. The technology's not 56K dial-up, but the way that the shift to the market is like 56K dial-up. And what we have to do is just keep thinking bigger and broader, and create these things, because we can create a whole new world and a whole new space of real estate if we choose to, and we want to do that. And I think that's been the biggest piece.
Yeah, anytime someone says 56K dial up, I just get those. Anyone that was around gets the flashbacks of the ISP provider pings and weird sounds your computer would make.
Yeah.
Oh
You
god.
remember the phones too back then, right? It
Oh
was
yeah.
like, I mean, pagers, right? Went from pagers to I remember the cell phones. My dad had one. It was huge. He had it in his car. I'm like, what is this thing? It's gigantic.
Oh yeah,
But
I remember my my family was in the car business for years, many generations in the car business, and back then, going to auctions, and the big thing was that you could have cell phones, so you could get live updates and pricing by someone on the ground there, and those things were in a literal suitcase with a big lead acid battery and a big cord and the Gordon Gecko looking phone. It was
yep,
they were
yep.
fun. But again, not to a point of my nostalgia for old tech, which there's a lot of it. The the kind of, again, the transition is something I'm kind of interested in. So these assets are basically LLC membership in, again, not to kind of diverge, but it is, you're buying the entity that owns the real estate. It's the single entity that owns that single piece of real estate. So when you buy into that asset, again, there's a cap table, right? So when you put the asset live on there, is it a cap table that's just based on like number of shares per like the value of the asset? Correct? Is that how it's kind of bound?
Yeah, so if you think about it, the way it's structured is you have a master LLC. So think of it as one giant master LLC that owns all these little ones in it, right? It's called a
Mhm.
series. And so if you, I was give you an example. Maybe you bought into a home, 123 Main Street, 40,000 shares. Maybe you bought 5,000 shares. Your interest is at the 5,000. So when you buy into it, you're buying in at that total gross purchase price. So, you go in, you pay to, or you want to invest. Maybe the home was 400,000, but the total gross capital raise is 420. I'm just throwing numbers out there,
Mhm.
right? Because you've got closing fees, you've got insurance, you got all this stuff that you got to cover, right? That's all built into there. Well, maybe the home is worth, 6 months later, we bought it for 400. 6 months later, it's worth 418. So it hasn't quite caught up to that 420, but maybe 6 months later it's 425. Now you get what I'm saying. So it
Yeah.
just follows that lead. We don't do it as basically at the exact purchase price of the home because we have to remember that people they're buying at that price that has some of those fees in it. So it has to make sense from that point.
Yeah, no, absolutely. And so once it transitions, once it's fully funded and that cap table is filled and moves to the secondary market, are the amount of outstanding shares locked or is it based on the price? By like just making sure, like, if you bought in, let's say, $420,000 cap table, right? And it goes up, let's say it's awesome, it goes up to 520, right? It's just an increase in share value, not necessarily increase in the amount of
An
positions
increase
you
of share
hold.
value. Exactly.
Okay,
Yep.
gotcha. Because the concern there would be, dilution,
No,
right?
no,
It
there's no
goes up.
dilution. So
Okay.
if the property's set with the shares never don't change, right? So if it's 40,000 shares in the primary, when people like, and I think of it as IPO, first time in primary IPO, 40,000 shares and moves to the secondary market, 40,000 shares. It's always 40,000 shares. Now it might be changing ownership; those shares change
Mhm.
ownership daily, but it's still the 40,000 shares.
No, absolutely, and I kind of assume that much, but it's always good to
Well, you
verify.
can't assume anything in the finance world. I mean, you know this, right? Like
Yeah,
assumptions get ugly.
yeah, exactly, and especially it's I've been involved in commercial real estate for at least the past 10 years. Kind of reading through all of the offering documents, PPMs, prospectuses, and seeing some of the stuff. And again, if you're dealing with a reputable operator that knows what they're doing, you don't have as much to worry about. But you see some of the ones that do have stuff baked in that can be problematic. And again, it's something that I tell people. It's like read it once, read it twice. If you still don't understand it, pay for an attorney. Because the devil is in the details in the finance world, and some of it's complex for complexity's sake. I feel like same kind of thing with cryptocurrency is that you know you have to really understand this stuff to a minute level, and unless someone's asking the questions and kind of breaking it down, which is what I hope to do with these kind of podcasts for people that are doing new stuff, is to demystify, make people feel comfortable and understand what's going on out there so they can make an informed decision. And again, not financial advice. Do your own research. But again, that's definitely good for the population. An informed population and an informed investor will typically be a more successful one, and a safer one.
Yeah.
So to that point, so it moves on, it matriculates out of the capital raise, goes in again, has a locked in amount of outstanding shares. Let's say it's 40,000 shares that were issued, and now it's on the secondary market. Is there any kind of lockup? So once it moves to that secondary market, is there an inherent lockup period where there can be no transactions, or once it goes live, again, real estate should be typically a longer term play. It's not something that people typically like to do, or there's much of a benefit to doing like an arbitrage or day trading play on. But is there a lockup to that, or is it again just kind of it is on the market, it is now on the market?
Yeah, no, there's still a lockup. It's on the market and it's free to go, I think down the road, when we built out the technology, we built it out for Regulation D as well, which is accredited. And so um, we siphon through information as it comes in, and our tech can basically figure out within seconds if you're verified accredited or not accredited. And then so if we ever bring accredited assets, so maybe a Reg D asset, an asset maybe like $150 million apartment complex. Who knows? I'm just throwing stuff out there. But
Yeah.
point being is it gets in front of the accredited investors, right? But the unique piece is after they purchase those assets, generally, this is not always, but generally after a certain amount of time, which is usually like a year, they can sell those assets secondary. And so those assets could even be on the secondary market down the road. So those
Awesome.
are assets that like everyday people never have really been able to tangibly buy into. But if it's owned and let loose later down the road, that they can. And so that's a unique perspective as well for the technology for down the road.
Yeah, no, there's definitely a lot of interesting, aspects to where this could potentially go, right? It's very cool to see its initial kind of adoption in real estate because, again, that's something I wholeheartedly believe in, whether it's me personally or my family or my friends or what I do professionally. There's always been a flavor of real estate somewhere in there. And to see it kind of, again, democratized and brought into the masses more is something that I'm always excited about. So, definitely, again, pretty cool to see how this is functioning from the initial offering and what that might look like once the more providers are kind of utilizing this, whether that's, your home builders or your build to rent people, or, even I could see, larger fund managers that want to have the ability to get just more liquidity into a fund listing properties in some form or fashion. There's a lot of really cool things that can be done with a tech component like this, from bringing in there, how it's initially funded, management, acquisition, and then the really cool part, again, because all that front end stuff is, not too dissimilar from what the market looks like currently. You plug in, assets are acquired, they're managed, you get a return. But it's that liquidity component that really is the exciting part for me here, is that, once you bring it in, you're steering the ship. You become that, your own little fund manager and can make your own decisions for that. Again, do your research, make sure that you're making good decisions. But again, having that franchise placed back on the investor is something that's been, taken away from us a lot over the past several decades. It's, you're not smart enough, you can't do this. It's like, well, no, we can, and we should have the option to do that if we want to, but there really hasn't been people out there, building out these kind of platforms.
Well, and I think that's because of the complexity of it. That's probably the biggest missing link. Like, this is, if you think about this, there's no player in the space that's offering this as an in-house secondary market ATS, usable, tradable, right there, right? Like, it's literally a click of a button or swipe. There's none of this nonsense where it's like, oh, we have this asset, we're going to try to list it on some other secondary marketplace, and you got to go build an account, figure out. I mean, that stuff is just as complex as making a phone call and going, hey, how do I get my money out, right? And so so the point that you're bringing up, I think, is such a massive point. But I have to be honest, like, when I first brought this idea to investors, they a lot of them they don't see it. I think when I say investors, I mean investors in our company. Like, they were like, how are you, what nobody, but my belief is that secondary market is going to be the biggest winning piece of this whole entire ecosystem, because you have to give people the ability to do what they want. People, once again, when we forget about the customers, we lose. And this is what inherently happens with a lot of this fund managers. They forget about, oh, give us your money, see ya, right? The way we took it is we said, hey, easy in, easy to understand, easy out. You decide, not me. I don't need to decide for you, right? You can decide. You're an adult. You know what to do. And I think the reason people have stayed away from it is from a tech standpoint, the complexity of it is, think about how the NASDAQ operates. That's the complexity of this system. The secondary market took us 2 years to build alone. That's just the secondary. That's not the main infrastructure primary. That's not the UI, UX. That is just the trading piece of it. I mean, the amount of work and code that went into that was probably 25,000 man hours of code to build that. I mean, it's not like you just wake up and go, we're going to do it. And when I brought this to investors and I was like, hey, we're going to have to raise a lot of money to be able to, like, build this, because this is going to be very expensive. Some of them were not too thrilled about it. They're like, you don't need it. You can just let people buy in. But I'm like, no, if they buy in, then we're doing what's the point? If we're going to do everything everyone else does, then what are we doing here? But I believe inherently that the winning ticket is a technology piece that allows white label, secondary, and distribution. So you think about, like, let me give you an example. Like, think about this in a big perspective. Say you have $100 billion of assets going through this a year or more, and it's being distributed on, like, a SoFi, a Robinhood. They could just do an API call right to our technology. Boom, boom, gather information. I mean, that is literally where this has to go in the future to be a winning scenario. and that wins for the customer, right? And actually helps win for the issuer as well and the distributor. It's really an all-inclusive. We all do well if we create this. But I think that's been the biggest fundamental piece that anybody in the space has totally forgot about, because their whole thought is, let's get these assets, let's keep them, and let's manage them, and let's not let people make decisions. Because if they can't make decisions, you get to make the money
Oh yeah. No, that's all fantastic points. I really enjoyed the conversation with you today. Kind of bringing this in for a closing. Certainly if people are interested in learning more or exploring your platform, how can they find you? Is it just a website? Is it an app? What's the best way to reach out?
You go to realbricks.com, or you can go to Droid app or iOS, Realbricks. And it's very easy to get onboarded. It's less than 5 minutes. You can connect your bank account, get onboarded. We have initial properties, but obviously our biggest focal point right now is the issuance and allowing distribution. So we're in talks with large issuers now, so we can get lots of assets on there. But yeah.
Awesome. Fantastic. Well, again, one of the most valuable assets we all have is our time, because we can't make any more of it no matter how much we invest. It's corny, but it does ring true. So thank you very much, Chris, for taking some time to speak with us today. With that said, my name's Alex Perny. This has been the Alternative Investing Advantage podcast. Thanks for joining us, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.